Welcome everyone to episode 49 of Top of Mind with Consilio Wealth. Today is May 20th, 11:58 in the morning. It's a beautiful Monday morning today. And Hao and I are back to cover the Dow hits 40K. I'm sure everybody saw the news. We thought we'd unpack what the Dow is. Does anybody know how the Dow is calculated? How many stocks are in it? What stocks are in it? What's the history of the index? We thought that might be an interesting thing to talk about today because there's some kind of cool history with that. Also, large cap outperformance. We thought we would talk through how the S&P has done relative to small companies. There is an interesting divergence that has almost never before been seen in history. And what does that mean for forward-looking market returns? Next up, we're going to talk about U.S. population migration. Said differently, Southern comfort. People are moving south, or were. And we thought we would unpack that for our listeners. The next item are market predictions versus actual. We're going to tell you straight up how Jim Cramer does relative to the market. Not really. We're going to talk about him, but we'll talk about others too, and just how good is the prediction game, and should you listen to it? Spoiler: you should listen to us and not others, but we'll give you some data behind that. And finally, the number of homes that are listed for sale is far less than historical averages, and the research would suggest that's due to mortgage rates. And we thought we would unpack that, the difference between the mortgage rates that are currently sitting on homes that are owned and the current mortgage rates, if you were to go buy that home, has never been further apart in history. Wow, we're going to talk through that too. Action-packed meeting today, podcast today. Let's start with large cap outperformance and also how the Dow works. I think you want to start with just outperformance of the S&P. So let's cover that as we start, and then we'll shift into the Dow Jones and unpack how the Dow works.
Yeah,
take us away.
Quick timestamp, May 20th at noon Pacific. Pretty good run up so far with S&P, recovering from, you want to call it the April sell-off. But yeah, that's
a good point.
Where we're at now, small cap relative to large cap, right? We use S&P as proxy for large cap. We get that there's more to invest than the top 500 companies in the U.S. Other indexes include like the Russell 1000, the Russell 3000. They include a lot more companies, right? Mm-hmm. And the number behind the index denotes how many companies are in there, right? 1,000 and 3,000. The biggest thing is that the divergence between small companies. So depending on how you define small cap companies, it really can change, because if I call something a mid cap company or small cap company, it's going to move up and down with the stock price, right? That's a big component of how the value of these companies are measured. What the stock price is times the number of shares available. It's pretty simple. So a good example of a large cap company is Apple. What, 3 trillion? 3 trillion?
It's about right.
Yeah. And then good example of a small cap company is some of the smaller brands. Probably using a bad example off the top of my head is Peloton.
I love Peloton.
Yeah. Very small market cap relative to Apple, right? Probably bad example, but I just wanted to use something that people recognize. But small cap as a group, right? All 2,000 companies are actually smaller than Apple combined. So 2,000 companies are smaller than Apple. And
there's a lot of opportunity in those 2,000 companies then, right?
Yeah. The next Apple, right? The next vendor to Apple, the next supplier to Apple, the next app builder for the Apple Store.
Yeah.
A lot of things in that universe that hover around that either benefit from Apple or directly compete with Apple. So when we say small companies, we really mean small companies that are publicly traded. And they've been lagging for the last 4 years, since 2020. They had a great banner year in 2020, but a lot of it was, a lot of speculation, pushing up SPACs and pushing up, unprofitable companies. But never had we had this long of a stretch where outperformance by the S&P 500 relative to the Russell 2000 had been this long since 1999. So we know how that ended. Right? Most of the large cap companies in the NASDAQ, right, didn't have justifiable valuations, then they dropped. So So a lot of people are questioning why they own small caps. They've always questioned why they own different asset classes, and I think this is a lesson in, stop chasing recent winners and stop dogging recent losers, because it tends to cycle around quite a bit. We can make the case for international or emerging market relative to U.S. It's always going to flip.
I want to ask you a question about the Russell 2000. So for context here, so there are many different benchmarks that mutual funds and ETFs will benchmark to. There's the S&P benchmarks and there's the Russell benchmarks, and there are others, but I'm just going to focus on those two.
Yeah.
The S&P benchmarks have a profitability component requirement in order to be in the S&P. So for example, to be in the S&P 500, you have to be a profitable company or a reasonably profitable company. It doesn't mean that you're going to get kicked out if you swing to a loss in a quarter, but you have to have a track record. The Russell indexes do not have those requirements. So they're designed to kind of take anybody and everyone. Something that's interesting, and I'll frame this around a question, How, for you that I'm curious on. Small cap, so common index for small cap is the Russell 2000. That's going to be the 2,000 smallest companies in the country, publicly traded. The current unprofitable percentage, so the number of unprofitable companies in the Russell 2000 index currently stands at 42%. So 42% of the 2,000 companies in the index are unprofitable. COVID-19, it was 53%. In the financial crisis, it was 46%. And in the tech bubble, it was 41%. And again, we are at 42% currently. So my question for you, Hal, is the Russell a broken index? Or is it still a viable way to measure small cap and small cap performance? What are your thoughts?
The way you set it up, it is. Gosh. 42%
Maybe, yeah.
Yeah. I actually, the next chart I had on the second page was, if you held the Russell 2000 and the S&P 500, you were up 491% in the Russell and 472% in the S&P, dating back to the year 2000. I get that that's post dot-com crash, but even though the unprofitable companies fizzle out, right, 42%, there's a high degree of, insolvency there. That index overall, because it's always being replenished with new companies, right? At one time, Google was in that index.
Yeah.
So was Chipotle. So if you have the idea of owning the next Google or Chipotle, yes, you have to make a lot of little bets for it to pay off. And you could see the index of 2,000 names that have been cycled through the last 24 years beat the S&P.
So that's 20 years? 24 years?
Yeah.
Wow. I think what's important to unpack here, because our listeners can't see this, I'm looking at a purple line, which is the Russell 2000, and I'm looking at an orange line, which is the S&P 500. The purple line is always above the orange line in this chart.
Except for the last 4 years.
Except for the last 4 years.
Yeah.
And I know that it would look different if we were looking at different time frames, like last 5 years and last 10 and that kind of thing. But what's I think interesting here, and I just framed it as, is this index broken? And you didn't give me an answer. So I'm gonna press you for an answer here in a minute. But what I want to point out here is during COVID, the Russell 2000 shot up relative to the S&P 500. And if we all remember what happened during that time is a flurry of unprofitable companies reached sky-high valuations because no one knew, or the market didn't know how to value, is Zoom going to pick up 100x clients overnight?
GameStop was in there too. Yep.
Say it again?
GameStop was in there too.
Yeah, well, that's a whole nother bag of worms. But yeah, so that's interesting. So this is like during periods of time when these unprofitable companies have signs of life. They are certainly worth more based on that speculation. I think the other important thing is that if 40% of these companies, or 42% of the companies right now are unprofitable, some of those will become profitable.
Yeah.
And we know, like, look what happened to Uber. When Uber swung a profit, their stock doubled. It was flat for, 10 years, and then it doubled as soon as they started to make profits.
Amazon and Netflix were unprofitable for years.
Also a really good point.
Yeah.
So I want to come back. So do you think it's a broken index, or do you think it's still a viable way to view those smallest 2,000 companies in the country, or should we, for example, focus our sights on the S&P 600, which is the 600 smallest companies according to the S&P, and there's a profitability metric there? What do you think?
Actually, yes and yes. And full disclosure, we have small cap allocation to the S&P 600, which bakes in a quality overlay and kicks out any unprofitable companies. So
yeah, we do.
But it doesn't mean we think that Russell 2000 is a broken small cap index, because I think it survives because there's so many companies in there. And on the chance of many home runs being hit, right, 2,000 companies, and just the way the American economy works, there's going to be successful stories in there. Throughout time, there have been, and there will be going forward.
We could probably unpack this for an hour, because I know that there's a lot of data on companies used to go public when they weren't profitable. They went public with a business plan to try to get to profitability. Now you're seeing a great fall in that, and instead a great rise in companies are going public now profitably. You have to be profitable first as a privately held company, and then you go public. And so the rise of companies that are going public are bigger. You're not seeing these $250 million companies going public. You're seeing multi-billion-dollar companies going public, and they're
skipping the index.
Profitable.
Yeah,
they're skipping the index. Exactly. So that's a whole nother podcast, but interesting nonetheless. Other final comments on this difference between large and small, or should we shift over to the Dow?
Yeah, let's talk about Dow. Pretty large index.
So unpack for us, for our listeners. So the Dow just hit 40,000, and to me, that's always kind of funny, right? Because what does that mean? 40,000 what? 40,000 units, $40,000, 40,000 price. What is it? And so I thought it would be really impactful for our listeners. Could you unpack what's the Dow? How many stocks are in the Dow? How's it calculated? How do you get into the Dow, and how do you get out of the Dow, get kicked out of the Dow, right? Just to talk about this for a couple of minutes so that our listeners better understand this very, very commonly watched and on everyone's TV index.
Yeah, believe it or not, this is probably the first time we've referenced the Dow. Anytime we've referenced the market, it's always been a better index, the S&P 500 specifically, or the NASDAQ. Just simply put, the Dow is a dated index that is a price-weighted index. So
dated. Okay, so Howe thinks the Dow is a broken index, but not the Russell 2000. But anyway, let's continue. Let's carry on. I heard that.
It started in 1896 by a guy named Charles Dow. I don't know where he came up with the name for that index, but there you go. He had actually a really good idea. Back in the 19th century, he had to give a snapshot of where the economy or the stock market was at. So he threw 12 names in there and made a composite out of them, where as the composite went up and down, there would be a sense of what direction the economy was heading. And I think that was an easy way for people back then, more than 100 years ago, to understand, right, the stock market in a snapshot. I think that's where the genius of creating something like that, because that was one of the very first indexes. And I think that's important to how we index now today.
Interesting. Okay. So it started as 12 stocks, you said?
Yeah. Now it has 30. So it hasn't really grown with the time. So over time, it's become less and less relevant, even though financial media does really focus on it. Because right now I'm looking at the Dow, it's down 162 points. And the S&P is up 7.76. What makes a better headline? Right? The 160. Yeah, because that's easier to sell papers than what it's really down is just 0.5%. S&P's up or basically flat at 0.15%. If I'm in the business of selling attention and selling newspapers, I'm going to quote the Dow. I'm going to quote the Dow in points, which is pretty irrelevant.
Which is always what we see, right? Largest point drop in history. Well, duh. That's just how the math works. Our listeners know that we are the first to throw darts at any of those articles that come out when the market sees any sort of volatility.
Yeah, I guess you're right, because that's the only time we do actually refer to the Dow is to take shots at it.
That's right.
Yeah.
Get out our dartboard.
As time progresses, the the price weighting become less and less relevant because these companies are, one, bigger in size, and the S&P, for example, is cap weighted, meaning wherever NVIDIA moves or wherever Netflix moves, it's going to shift the markets relatively more than Chipotle, for example, right?
Mm-hmm.
So versus right now, the Dow components, we have a handful of names, right? Just 30 to be clear. You have Amazon lined up next to Intel, right? Amazon's trading at $190 a share. Intel's at 35. Depending on where Amazon moves, because it is bigger, probably another set of bad examples, but the price itself is going to impact the index more than how big the company is. And that's not a really true reflection of where a snapshot of the economy is.
So price weighting means if I'm a $200 stock and I'm put next to a $300 stock, that $300 stock has more weight
correct
in the Dow compared to the $200 stock, correct?
That's correct.
All right. So that's why we'll see in the news sometimes, the Dow went down by this amount or went up by this amount, and the top contributors were this and this, because there's only 30 stocks in there, and some stocks have a little bit more weight. Now, with that said, there's sort of a range, right? So like you'll hear of some stocks that will go through a stock split because Amazon at $3,000 a share will never become a component of the Dow, right?
Correct.
You have to be within a range. So what is that range, and what, how do companies ultimately get into the Dow or maybe get kicked out of the Dow?
Yeah, there's no published range, but it is the components are selected by a committee, and they're out for optics, right? So if they're kicking out a high price name, even though it's in financial straits, and they bring in a lower price name, that's going to show a big drop in the Dow, and then everyone's going to think the economy's gone to hell. So
because they would have to recalculate.
Yeah. So that's why the committee, even though they don't have rules, they want to keep the price levels in range. And right now, it does have a pretty big range, anywhere from $30 a share for certain companies to $500 a share for United Health. But
really?
United Health,
30 to 500?
Yeah.
Wow.
Yeah. So United Health has the biggest weight. Yes, they are a big company, but by sheer price size, they have the biggest shifting in the index. And if United Health split, right, they would have suddenly less influence on the Dow. But the Dow committee will most likely encourage them not to split, because that would change the makeup of the index. Even though splits, as we've proven, don't change the value of an overall company.
So it says here that companies can get removed if their market cap or the total size of the company shrinks significantly, or if they experience financial trouble. I know that we don't have it in front of us, but there's been a long history of companies that have been added to and then kicked back out of the Dow. Is GE still in the Dow?
Actually,
yeah, I don't know.
Look,
I'm
gonna look
I know
that
that
up,
it was. Yeah, that's interesting. So I think it's all up to this committee, which is interesting because the committee's trying to have this perpetual price expansion.
correct. It's great
And
for
it's
airlines.
price weighted, which
GE's
is
not in there.
interesting. Yeah, that's right. 'Cause
And thanks
I
for
remember when they
stalling
got
for me.
kicked out of the Dow.
Yeah. They try to keep
I thought I
themselves
remembered
in
that
by doing
correctly.
a reverse. Yeah, they try to do a reverse split to try to salvage their participation in a line of indexes.
And I think the last thing here is how is the index calculated? Like, is it as simple as add up all the share prices, or like how does that work?
Yeah, that's price weighting. That it ignores the size of the company. So yeah, just add up all the prices.
Interesting. I know that it's that, and then there's also some other like twist on it where like to account for stock splits and other changes, there's like a divider to try to equalize. I don't know how much that's really done and how that just smooths returns, but there must be some sort of a objective of this committee, because if you're a $50 stock or a $300 stock, as you pointed out earlier, obviously that $300 stock has significantly more weight in the overall index. Okay. Cool. Well, thanks for that. a little history on the Dow. Some things I didn't know. I learned some stuff there, so thanks for that.
Yeah, probably the last time we'll reference it in a serious manner here.
Well, until it, has the largest point decrease in history, which is inevitable, and then we'll bring it back up. We'll bring it back up. All right, let's move to U.S. population migration. Southern Comfort, SoCo. People are moving south, and this is interesting. We actually have a ton of data on this, not just trends by states, but also things like high-cost states, income tax, cost of living. There's a ton here. So I'll kick us off here by just going over this first chart here. What I have in front of me are the top 10 growers and the bottom 10 growers by state. U.S. population grew by about 0.5% over the 1 year ending July of 2023. So this data is almost a year old, but there was some pretty key regional divergence. The southern states saw the largest increase, which was about a 1.1% increase in population. So you think total U.S. population grew by 0.5%, but the states in the south saw 1.1%, so more than double of that growth, while states in the northeast was the only region with negative growth of 0.1%, and that was led by the great state of New York, which I just visited, and it was still busy, so I experienced this 0.5% decrease in New York.
That seems noticeable, right? Like less competition for taxis and...
It does seem noticeable. Well, and I do know that specifically on Manhattan, I think that the real estate there has continued to be, it's not flying off the shelf, right? This is one of the most high cost areas in the country. And, I don't think that their values have skyrocketed like they have in other areas, or been supported. So some in the bottom 10, New York, as I mentioned, California, Oregon, Hawaii, Alaska. These are states that commonly have had very, very high, whether it's taxes or cost of living. Hawaii is a very expensive place to live, for example. Top 10 growers, some states that come to mind, everybody probably is going to say Texas, you're right. Florida, you're right. So the news is correct there. Some states up by us in the Northwest, Idaho is one of them, and Utah is one of them. But then you've got other states sort of in the Southeast, Georgia, Carolinas, Tennessee, those kinds of states as well. So Hal, I want to kick it over to you. You had some interesting additional research on this, things like taxes per state, cost of living per state, real estate costs. So what are you seeing as we unpack sort of this population movement and migration across the U.S.?
Yeah. Let's look at the taxes first. I think that's kind of like the touch point for a lot of reasons to move, right? I got to move out of California because the taxes are so high.
Yeah.
This chart surprised me. This is from a Visual Capitalist. They took the average tax burden, so they included, income taxes, state and local taxes, including property taxes. California and New York are the upper quadrant in terms of highest rates. New York is at 12%. California is at 10.4%.
And Hawaii.
In Hawaii,
11.8 for Hawaii.
Yeah, and I should see that. The lowest.
This is, by the way, this is percent of personal income paid towards state and local taxes. Yes. This is what we're looking at in this chart.
Yep. So Alaska is the lowest at 4.9%. Florida is on the bottom tier with 6.1. Wyoming is in there with 5.7. And New Hampshire, probably the cheapest, tax-wise, cheapest state to live in, 5.6% taxes. What surprised me about this chart, though, Texas 7.6%.
Yeah.
North Carolina,
and what
South
was Washington?
Carolina. Washington 8 flat. So Washington, in according to this chart, is pretty neutral in terms of tax rates on average, right? Because we're using 8% as a mark of demarcation, where we're anything below 8 is cheap, anything above 8 is relatively expensive, and Washington's like right at the line.
Interesting. So, and this is so based on property tax, individual income tax, sales, and excise tax. And this is percentage of personal income paid for these taxes. That's interesting. The obvious states are going to be California and New York with high income taxes. Texas, though, I know has very high property taxes. And so that's probably what's pushing up their overall taxes for living there because you're being taxed on a big asset, right? Your income is probably less on an annual basis compared to the value of your house. So you're paying, I know, a larger amount of taxes in Texas can be, upwards of 2-3%. Whereas in Washington, we're more like 1%, but then we have sales tax, but no income tax. So this is very interesting to see. I guess what's not in here, so sales tax is in here, but what's not in here is like cost of living. Correct. We talk a lot about gas prices and how it genuinely feels good or bad when you fill up and gas prices are higher or lower, right? Like when I fill up and it's over $100, it's like, geez, it's crazy. When it's under $100, it's like, oh, such a deal. And so like it actually makes me feel different. And so, I know, for example, in Texas, gas prices are, I think, cheap. In the twos.
Yeah.
California's really high. Washington's really high, for example. So, I don't know. I'm just surprised to see this. I don't know if it's fun with numbers or if, what's your take?
That's why I think the next question we'll get to is the cost of living. But the tax rates surprised me because Texas and Florida really advertise themselves as tax-friendly states. And Florida definitely lives up to its name at 6.1%. Texas doesn't quite do that. Kansas as well. Kansas surprises me at 9.3%.
Yeah.
And that feels like you're getting taxed twice, right? Because one, the 9.3%, and then having to live in Kansas.
You're telling me Kansas is more expensive than Washington?
Correct. Without the amenities of Washington, right? Because I don't know if you've been to Kansas. I've been there a couple times. Probably wouldn't go back.
I've never been to
Let alone
Kansas.
live there. Yeah.
I mean, Utah.
That's why they call it a flyover state.
It's interesting. Yeah, a bunch of farms, right?
Yeah.
Okay, so then let's move to, you said cost of living. So let's move there.
Yeah, so the cost of living kind of has to integrate wages, right? So the wages in Texas are down significantly relative to Washington. And we're using a chart that measures average wages for different size companies, right? And this is from the Bureau of Labor Statistics, so it is government cited. We're just going to quote the 1,000 or more employees per establishment. So relative to Washington, the weekly wage average is $32.91 for Washington. That equates to $171,000 in annual salary if you work for a company that is 1,000 or more employees. The smaller size companies are still in the same ballpark. So that's why I'm just using that as an example versus going through all the data points.
Yeah.
Yeah, Texas, for example, is $22.38 per week, and that averages up to $116,000 a year. So significantly less pay to move from Washington to Texas to save about 0.5% in net overall taxes. Yes, we're getting the wages, or we're sticking with wages for right now. We haven't really gotten to cost of living, but you could see there's essentially a tax if you're a working professional moving from Washington to a lower tax state like Texas, because you're just simply not going to get the wages unless you're working remote. And I think that's a big issue.
So in rough numbers, I'm making $1,000 less per week at the high end when I moved to Texas compared to Washington. So that's like a third less.
Yeah.
But what we were just talking about was the taxes are 5% less.
Yeah.
So I think what you're trying to frame here is there's a tax that's not showing up in tax, which is wages.
Correct.
You're making less money.
Yeah. In California, for example, you're making less in California than Washington on average, $160,000. So yeah, Washington seems to hit this sweet spot with relatively low taxes.
$3,100 a week,
yeah,
versus $3,300 a week. Interesting. California is a way bigger state, though. There was a report that you showed me. I don't know if we have it in here or not, but I called BS on it because
I took it out. It was trash.
Yeah, see, well, it was like saying all of California is this cost or whatever. It's like, that's not right. That might be LA, but that's not, and even like if you look at Seattle, there's many different areas of greater Seattle area that have a range of cost. And specifically, like if you go east of the mountains, then you're in a whole different deal. So like, I think
Yeah,
this
yeah.
report was quoting just the highest place possible to live in every state, which I thought was BS.
Yeah, to let listeners in,
Anyway.
it was a similar map, and it said the cost of living for a family of four, and it said
Oh, that's right.
yeah, what you would
Income
need to live
required.
comfortably. Yeah, income required. It said California was 277,000, which is, even in an expensive state like this, is very, very out of this world. It said Montana you needed 219,000. So right off the bat, we were like, this data doesn't really jive with real life, so we tossed it out.
Yeah. All right. So this is interesting. So,
Yeah, and hitting Florida, their average
Oh, yeah.
is 1528 per week, which equates to 79,456 per year.
half of California for context.
Yeah, so if you're taking the net of taxes and income, you're actually down 40 something percent. 45%. If the move was to save taxes, it just doesn't make sense.
There's a lot here, more than we would be able to unpack, because there's the cost of my favorite product, eggs, and housing and sales taxes and property taxes and all these things. So there's a lot here to unpack to like truly get the numbers. But this is kind of ringing with me, because a lot of these sort of cost of living things are, in my opinion, kind of fun with numbers.
And misleading, very misleading.
Yeah, well, and even to the extent like, you've all seen the bus ads on the side of the bus, and it's trying to get you to go vacation in another state. Like, states are spending advertising dollars on their state budget to try to go get you to come to their state to go have fun and go bring your families there for vacation. And, that's in some cases I've seen some of these ads saying, we're cheaper than you, basically. And it's like, are you really? And are you really in vacation towns? Maybe not. So yeah, I think a lot of this stuff is kind of misleading. What's next here? You've got taxes on homes and average home prices. Okay, this is interesting.
So yeah, property tax is probably the biggest thing next to the income, as Chris suggested, income tax. So states without income tax, make it up somewhere, right? It's not cheap to run a state, even in a low tax state like Texas.
Yeah.
Their income tax is more than double what California is at 1.63% per year. And that's how they fill much of that gap, right? Like, I think it's at the state level, it's hard to operate with little to no revenue. Washington stands
that's 45th on the list here.
Yeah, one of the worst states to
one of the highest. Yeah.
Washington is middle again. I think what I'm coming around with the data is it's found a relatively good balance, and I know we're speaking to a lot of Washington listeners who probably feel different, but look, if you're looking at the numbers relative to other states, it's actually not the worst. California is actually upper tier because we do have a cap on property taxes, and the average is 0.71%.
That's right.
But Washington is 0.88%, so significantly cheaper than Texas still. But again, you're coupling that with no state taxes in the state.
Looks like the average house is about 40% more in California too. And again, that comes back to California's a big state, and there's a lot of stuff in California that's much less expensive. I guess there's a lot of stuff in Washington too. You go east of the mountains, you go way north, you go way south, outside of Greater Seattle area. There's a lot of homes in Washington that are well under these averages.
Yeah, and the median home value in Washington is worth $473.
Mm-hmm. Oh, median. Thank you.
Yeah,
not average.
And the median home value in Texas is $238. And median versus mean, we should use averages, but I'm just using the data from BLS. I don't know why they use median, but I think it's still kind of in the same ballpark.
I think it's a better gauge because it's truly the middle home, not the average. Because California's median home is about 660,000. If you put an average in there, I would assume it'd be far higher because you've got these $58 million homes.
Beachfront properties will skew.
Yeah, and it would swing that higher. So I think the median is probably a better gauge in this case.
Yeah, in Texas, 238. Again, you're not getting as much value out of the property.
Mm-hmm.
Again, it would be much easier to buy in Texas because it's cheaper.
Sure.
Versus Washington, but again, you got to weigh all these out against each other.
Yeah, and then contrast that with higher mortgage rates, but that's a whole other
Yeah.
issue. Yeah, I wonder,
Yeah.
we were talking about this before we hit record, this population migration. Is it people selling homes and buying homes, or is it people who are renting homes and they're going to buy? Or are they renting and renting?
Or they're
You know?
retiring, and they're paying cash.
That could be.
Yeah.
Yeah, percentage of
'Cause-
homes. That'd be an interesting thing to look at. Percentage of homes that are cash buyers, which I don't know off the top of my head. I think it's been relatively consistent for the last number of years. It hasn't like spiked or fallen. Relatively consistent. I think it's slightly increased actually, but not, it's not spiked. It's not like, oh, higher rates have spiked cash buyers by 30%. I don't think that's true. Somebody might totally prove me wrong, but off the top of my head, I don't think that's true.
Yeah.
But yeah, it's interesting to see, are people moving and renting? Are they moving and buying? Are they selling and buying? In Washington, it sounds like no one's selling. So if you're moving out of Washington, where are you going? Are you keeping your house and renting it? I don't know. Presumably that would put a downward pressure on rental prices because then there'd be more homes for rent. So, I don't know. I don't know where all these people are going.
I don't think it's as clear as cut as I'm going to move a state with lower taxes. And I think that's
I think in some that's
really
what we're trying to say.
way. Yeah.
Let's move to the predictions versus actual performance. So predictions is probably a multi-billion-dollar business. There are a lot of people that are on TV. There are a lot of people that write articles in the Wall Street Journal, columns and whatnot, and they're all about predictions. We talked about this a little bit a couple weeks ago. We thought we would revisit it, which is how accurate are these predictions and should you follow them? I want you to unpack this, how this target practice piece, and then you've got some other sort of interesting research that you did on this. So go ahead.
Yeah, the predictions suck. It's predicting the future, which we know even the smartest people who have taken all the information, they're going to get it wrong because something's going to happen they just didn't see, right? Mm-hmm. How many people last October figured that Israel was going to be attacked? Right? How many people? Yeah, how many people guessed that Russia was going to invade Ukraine? It just these kinds of noisy things happen, and not to demean any of these military engagements as noisy, but from a market point of view, yes, it's something that disrupts the market. So, yes, the prediction market, as Goldman quotes here, 17% off. So meaning, I'm going to say the market's going to be up 17. It might turn into 34. So
hold on, I got to read this. Over the past 4 years, the average difference between the median S&P forecast at the beginning of the year versus the actual level that the S&P finished is 17%.
1.7, yes.
Not 1.7%. 17%.
Yeah, that's huge.
That's ridiculous.
You would think a good forecaster would be, with 5. A few percentage points on? Yeah. But at this one, we'll take a 10, right? A low teens versus 17.
Wow.
So it shows you how hard this is. This includes Goldman's own in-house forecasting, right?
Sure, yeah.
So that prompted me to look at the study by the CSX group. They looked at forecasting accuracy and track record, and they came up with a list of forecasters, researchers, money managers, anyone who publishes a public forecast for us to scrutinize, right? So on average, this might scare you. There's a 47% accuracy rate. So if I flipped a coin, I would do 3% better than these professional money managers, which is wild.
Accuracy. Do you know how accuracy is measured? So what is accuracy within 5% of the actual, or like how? Because it can't possibly be that 47% nailed it, right? We know that didn't happen.
Yeah,
so how's accuracy defined?
Yeah, like how specific were you in terms of your price target, your time frame, right? If you said, well, the S&P is going to be up 5%. But I said over 10 years, right? Like that doesn't matter to a lot of people. Directionally, it matters, right? Which kind of falls into the like specific price target that you put in, and they weigh that essentially with your track record.
So these track records, you've got a lot of information here, and I know you cut off this image. So some people are, really bad. The lowest one on this chart is about 28% accuracy, but I know you said it went a lot worse than that. The best one here is about 68% accuracy. What did you find as you looked into these ones that are more accurate and less accurate?
Yeah, let's start with the good ones. The ones that are more accurate, the top 12% according to this chart, they were right an average of 65% of the time. But I dug through their record. They all had one consistent pattern. They were all bullish. And guess what the stock
That's
market
why Hao
did?
Dang's name's in here.
Yeah,
That makes sense.
always bullish.
Yeah.
But guess what the stock market did during those prediction periods?
But the stock market generally goes up, right? It generally goes up and to the right. You've heard it
goes
here.
up, yeah.
Not
during that
first.
prediction period, it went up 75% of the time.
There you go.
So even then, if you rode up, because the top guru, we call it here, the top guru was accurate 68% of the time. But all you had to do was simply ride the bull market, which, this was data compiled from 2000 to 2012, or 1998 to 2012. So we did have a bit of a dip, which probably shows up in the accuracy scores in 1999, 2000. So I think it's important to know what the context was, because the market was going up, and if you're bullish, you're going to go right up with that market.
Sure.
And on the flip side, the worst decile, I guess, is averaging about 20% accuracy. Guess what they had in common?
Negative.
They were negative.
Doomsayers.
They were
Michael Burry.
they were saying the market was going to sell off. It never did, and therefore their score is reflecting on that because they took the exact opposite.
So where's Kramer? That's what everybody's wondering.
Yeah, Jim Cramer is on the list, and he's at 46.8%, which is right in the average.
Okay.
Still not as good as a coin flip, and I don't know how much CNBC pays Kramer. This whole list is highly paid individuals. They either manage money or they sell their research. So someone's getting ripped off here, up and down the list. So I think that's the lesson here is, one, if you're a forecaster, you've got to be bullish, right? You've got to stick with historical trends, or you're going to be skewered in the bottom, decile of this list.
I'm not surprised by any of this, right?
Yeah.
Markets generally go up and to the right. Good companies generally prevail. Indexes generally win, right? And there's going to be black swan events, and also there's going to be recessions and pullbacks and things, and interest rates will move. The Fed is going to do something. Market's going to get spooked. Whatever. But I'm not too surprised that the ones that skew sort of like betting on the trend, the longer term trend of bad things that happen in companies will figure out, or good well-run companies will figure out a way to reinvent themselves, become profitable again, that kind of thing, versus the ones that are just doomsdaying.
Yeah.
That everything's going to come falling down.
Believe it or not, I come around to not dismissing these forecasts. I think serious investors should read them, if anything, for a difference of opinion.
Mm-hmm.
So if you get a bearish take and you're bullish, that's actually stuff you should be reading to really check out, to see if there's any holes in your game, right? Like if you're missing anything. And I think that's a big thing with the other side too. If you're uber bearish, one, you've been wrong the last 20-something odd years, even with the pandemic, right? Even with the great financial crisis. I think if anyone were to rely on these, I wouldn't rely on any single commentary. You do have to pull them together and kind of come up with your own investment thesis.
Yeah, well, and I think confirmation bias is real. So try to align who you read with somebody that's generally more
contrarian to you.
Well, I guess I was going to say kind of like aligning with the trend of the broader markets, which is going the right direction, versus somebody that is constantly seeking for the next blow up and trying to predict that, because they're very likely going to be wrong.
Yeah. And I know this study ended in 2012. I found the bottom predictor and looked at some YouTube videos that published this year. So he's still in the prediction game. And those YouTube comments were pretty eye-opening, where a lot of people took his advice and got out of the market in 2011, 2012, 2013.
Oh, wow.
And yeah, they missed out on really great years. And those are years you don't get back because you listen to some random guy, however credentialed or not, right? That's just bad.
Wow. Wow. So people are actually commenting like, I listened to this guy's advice. I lost money.
Yeah.
Wow.
Because they sold everything, went to cash in a bull market.
Yeah. Went to cash, bought gold. We've heard this here before. All right. Anything else on the forecasting, or should we move to our final topic?
Yeah, let's go. Got locked in Seattle.
Okay, cool. Let's go here quick. I know we're almost at time here. So this is I was blown away by the statistics that were read here, that are in this article here. So this is from the Puget Sound Business Journal. So for context, this post is about higher mortgage rates and people feeling locked into their homes, and that leading to fewer sales in the greater Seattle area. That might not be shocking, right? If you're at 3% or somewhere around there on your loan. We have conversations with clients all day long. They say, I can't even afford my own home now at 6 or 7%. Or they'll say, I'm not moving. I'm going to do a remodel. I'm going to do something else because I don't want to pay a higher rate. So we hear that within our own subset of clients. I think the data here is interesting. So according to this research here, with mortgages over 7%, that has prevented 23,250 home sales in the Seattle metro area between mid-2022 and the end of 2023, so call it 18 months. This is according to new research from the Federal Housing Finance Agency. The average homeowner in the metro area is sitting on in the metro area of Seattle, that is sitting on a mortgage rate of 3.7%. And if re-originated at the current mortgage rates with that average loan balance, it would be an additional $813 a month, which is a 44% increase in payment. So no shock, right? People are looking at this going, I'm not moving, because you're generally moving to upsize, more space. So I'm going to have a big increase in payment with my same mortgage, and I'm not going to have the same mortgage. I'm going to have a bigger mortgage in my next place. So the effect on lower rates and people feeling more locked in is real. What this is saying here is there are people that are willing to buy, maybe the ones that don't care about higher interest rates, but they're all competing for a smaller number of homes. Historically speaking, never in the last quarter century has the rate difference between existing mortgages and new mortgages been larger than 1.51 percentage points. And think about that for a minute, right? If you're going to sell your house and move, and you're going to go from like 3% to 4.5%, that's a lot, but it's not that crazy. But if you're going to go from 3 to 6.5, that's huge. 1.51% is the gap in the last quarter century, average gap. The current gap is 3.7%.
Yeah. I think
That's
the problem
wild.
The problem with the benefit of hindsight was letting the rates go so low for so long.
Yeah,
Now we're
right.
creating this golden
Correction.
handcuff situation where we thought the higher rates would eventually bring down home prices, but we didn't think the next step would be everyone's locked into their current homes because they don't want to trade up, or they can't, right? Like I think that's what the Fed didn't see either. Is we're going to raise rates, home prices come down, therefore inflation goes by. That we're seeing something else happen where no one really anticipated how many people psychologically locked in, financially locked in, whatever the case is. They're not trading up. It doesn't make sense for majority of homeowners now.
This chart, which again is from the Federal Housing Finance Agency, so this chart begins in the first quarter of 2008. What an interesting time that was. The existing mortgage rate was below the new mortgage rate just for a hot second. And the new mortgage rate has been below the existing mortgage rate for basically the entire time of this chart, which means that people were refinancing lower. They were buying, they were selling, they're getting a better deal on their house, possibly even trading up in size and having the same or less payment, right? So this, the average of the existing rate continued to trend down from in the low sixes all the way to the low to mid threes. Now it's trending back up because new mortgages being originated, of course, are higher, but the vast majority of mortgages are sitting at these lower rates. And only, so it did spike above here in 2018. The new rate was higher than the existing rate, but then rates went flat in COVID. And ultimately it didn't swing back above until the first quarter of 2022, where again, new rates are far, far higher than existing rates. All of this has led to active listings in the Greater Seattle area taking a huge nosedive. So there were 7,000 homes listed for sale in the Greater Seattle area in August of 2022. Last August in 2023, so August 2023, only 4,500 homes listed for sale. So 7,000 going to 4,500. And in January of 2024, only 3,300 homes listed. Crazy. So the listings are taking a nosedive. You have more people competing for those homes, which is actually supporting prices. It's a conundrum in and of itself.
Supply and demand, yeah.
And rates, to come back to the initial point here that I think blows me away, the gap between current rates and existing rates on existing homes is 3.7%. Historically, it's 1.51. I don't know where this corrects, but I just thought this was like super, super fascinating. I want to make sure that I talked it through.
Yeah, I don't know how it corrects because you lower rates. I don't know. The rational thinking would be lower rates means higher home prices. Again, but the
that is
fluidity.
The rational thinking, yeah.
Yeah, the fluidity should open up a lot more supply.
Yeah.
But at what rate? I know I said 5% before. I think psychologically that seems to be more palatable to trade in a 3 for a 5.
Well, I think
But
if we
still.
get back into this kind of range, 1.5% above current rates, which if that current rate, I know a lot of people are in the 3s or below 3. This is saying the current rate is about 3.7 as of the fourth quarter of 2023. And that's, again, trended up from about 3.5, not much of a trend, but trended up because newer homes are being originated in the 6s, maybe even in the 7s. And so, possibly if we can get back into like the 5s or in the high 4s, maybe people start trading homes again. We're a far cry from that, but that I think could start to spur more home activity in terms of buying and selling.
Really interesting stuff.
Cool. Love it. This was fun today. We ran a little bit long, but we covered a lot of ground. So I hope this was fun for our listeners as well. Thanks everyone for tuning in. As always, if you are not subscribed and you're just listening to this on the whim, please subscribe. And if you thought that this was interesting and that one of your friends or one of your colleagues should listen to this as well, send them a forward. Say, hey, I have this cool podcast to listen to. It's informative. So forward it on. And if you don't think that way, then forward it anyways and say, hey, you should probably start listening to this. No, not really.
I hate these guys, but you should listen.
All right. Thanks everyone. That's right. Thanks everyone for tuning in. We'll catch you again in 2 weeks.
Bye.